trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, good morning once again, Market Rebels. And yes, this is becoming routine, isn't it, Stu? It is morning. It's Wednesday morning. We normally do this live at 4 p.m. on Thursdays. But again, for some scheduling conflicts, we're doing this early. So we don't have if you're wondering why the market numbers are a little bit off, that's why. But Stu, I think our markets were a little flat. Futures this morning, what are they doing right now?
Up a tiny bit. Looks like Dow might be up about 130 points, like maybe 0.3 and 1%.
Yeah, less than a fraction of a percent. All right, but at least we're not down. So a little bit of a pullback there from some of the additional tariffs. Had a couple of attempts to bounce back. Looked like we were trying to rally yesterday, sold off into the close. So we'll have to see how it plays out. But that actually is a good segue into what we're talking about here.
Yeah. Mm-hmm.
And one of the things that we get a lot in our Q&As is about hedging. And everybody hears that options are about hedging, that's what they were designed for, but we can use them for speculation as well. But people kind of confuse these topics, and they don't really understand what it means if it's a hedge or if we are speculating, or why sometimes they can cross the lines. They can actually be a little of both. So we thought, let's do that as a topic, kind of try to clear up some of these points. So for our Chalk Talk question today, this is our little thought-provoking question. We want you to think about it, jot down your answer, and then at the end of the presentation, we'll give you the answer, or at least our 2 cents worth of it. So here's the question. You're fearful of ABC share price falling. If you buy 2 puts, are you hedging? And we get this a lot. People say, oh, I'm really fearful of it. I'm going to go buy extra insurance. I'm going to go buy 2 puts per 100 shares. Question is that really a hedge?
Or I bought it at 25 and now it's 125 or 225. I think it's going to go back down. How do I
hedge it? And a lot of times they say, well, I want to get extra insurance. So here we're assuming it's 100 shares of stock, but then they want to buy 2 puts. Normally you would buy 1 if you want it to be an exact hedge. So that's what this question is.
And you know what? Let's take 1 second about that. 1 put, everyone. 1 put, 1 contract on all the listed exchanges, unless otherwise noted. 1 call or 1 put will deliver 100 shares, whether it's long shares. So it's 100 shares. And when you have 100 shares in your portfolio, if you have 1 put, it's going to deliver 100 shares. That's going to cancel the 100 shares that you own. Yep. But when you have 2 puts, then it's 200 shares.
Yep.
Now you're starting to cross that line. And that's why we say it's, you can basically insure your price of your stock value at that strike price.
Right. It's a little bit like saying, I know it's not legal, but conceptually, if you said I have a $50,000 car and I've got $50,000 worth of insurance, but I want to buy a second insurance policy on it. I want to doubly insure it.
Yeah, I want to insure
And
it for 100.
I want
Yeah.
to insure it for 100 because I really want good insurance. And the question is that hedging? So we're going to look at that, and we chose this for a question because we get this all the time in Q&A. So here's our topic for today, appropriately so, blurring the lines, hedging versus speculating.
And it is so appropriate that that's the way you put that on that graphic.
Because people, we're going to find out, even for professionals, they can cross the lines. A lot of it depends on how you want to define your
Yeah,
hedge and over what period of time.
they're always changing, right? There's nothing
Yep.
about this business that is well, very few things are very
Very few things.
and because it's so dynamic that these numbers are always changing, it can really go back and forth and back and forth.
Yes, they
And
can.
like why it's so important to really know what your goals are and know where you are at all times so you know how to react if indeed you need to react. And doing nothing is also a reaction, by the way. Let's not
Yes, it
forget that.
is. Absolutely. A lot of times it's your best decision when you really can't make a clear-cut decision. So before we get things kicked off, please remember marketrebellion.com/get started. Right there on your screen, great little link that can take you to articles, videos, all kinds of information on topics just like this to help you understand options better and, more importantly, to make better decisions. So let's kick things off with definitions. I think it's always important to define what we're talking about. A lot of times instructors just assume that people know what these terms mean. So hedging, kind of a weird word. Where does that come from? Well, it actually comes from the days of the ancient farmers that they would build or plant shrubs or hedges around their property to kind of say, hey, this is mine, keep out. And so that's where it came from, is that you are creating a barrier, usually to protect against risk or downside risk for most portfolios. And that's what it means to hedge, that you're creating some type of a protective barrier. So the thing with hedging, the definition that we want you to think about is that you are reducing gains, you're giving up some of your gains in exchange for reducing risk.
Bill, I have a question for you.
You go for it.
Did you make that up?
Gotta make what up?
The part about where hedging, the term
No,
hedge
no, that's actually where it came from.
is great.
You didn't know that? Yeah,
I didn't
yeah.
know.
It's exactly where it came from.
Oh, that
Sometimes
is
you'll hear people like a hedgehog. If you know what a hedgehog is, it curls up into a little ball. It's got spines. Sometimes they'll call it a hedgehog strategy. In other words, curling up, protecting a protective shell around it. Yeah,
okay.
that's where it came from.
Cool.
Literally.
I know what Bill's going to come up with.
Okay, so let's move to the other one that is a little easier here for speculation. And this is where we are intentionally seeking out risk, and we're doing it in exchange for bigger gains. So if you are accepting risk, saying, I want to go buy shares of stock, is a degree of speculation. You are introducing risk into your account that was not there in exchange for hopefully getting bigger profits. So anytime that you are accepting risk or increasing the existing risk of an account, and you're doing it for the reason of trying to increase profits, then you're leaning into speculating. Okay, so playing roulette would be speculating. Buying a call is speculating. Buying shares of stock. They're all ways of accepting risk, but you're doing it in exchange for potential profits. So let's take a look at start with some classic hedges, and we'll see how they compare to these definitions. Let's look at stock plus put. So as Stu mentioned earlier, one put contract, unless it's what's called an adjusted option, will control 100 shares. So if you exercise a put, you will sell 100 shares. If you don't have the shares in the account, you'll have a short position. If you do have the shares, they're just going to take your shares, ship them over to somebody else, they're gone out of your account. But it's for 100 shares. So if you have 100 shares of stock and you say, I'm a little fearful of this, it's unlimited downside that I have, let me go buy some insurance. That's kind of a classic use of a put option. We pair it up with stock, and now we've insured the downside. But let's see how this plays out. So here's our shares of stock, our risk graph that we've talked about so many times before. So we have, if the stock is at 100, that's where we cross zero, where we break even. And it's a straight line, so that just means we make dollar for dollar as the stock rises, and we lose dollar for dollar as it falls. That's why it's a straight line. So notice that we have unlimited downside, at least down to a stock price of 0. Now, when you buy that put, what happens to our risk graph here, Stu?
I think it's going to flatten out, right, Bill?
We're going to flatten out, because if we buy, let's say, the 100 put, we move from the black line to the blue.
And remember, everyone, what we said before, right? You get the right to sell the shares, right? Just think of it as money. The shares are representing money. You get to sell that money at that strike price.
Right.
And that, another way to say it is like you're going to stop losing money, right? Because you get out of it. You get to sell it. It's the right to sell it.
Right. Even if the stock is down here at 70,
you can sell it up there.
We can exercise it, and we're going to receive the strike price or 100. And that's why we always get a bend at the strike.
So and you pay for that. That's your premium.
That's your premium. And so we can tell that right here, it looks like that option probably cost us 5. We're not taking any risk from the stock because we paid 100, or at least that's its current value, and we can sell it for 100. So there's 0 risk there. So all of this loss here is strictly from the cost of the put.
Doesn't seem like such a bad deal, does it, Bill?
Doesn't seem like such a bad deal, but we have to look at.
Afraid of buying an option.
Yep. But we are also, there's some other things that we have to consider. One thing is that there's always, as I mentioned before, blurring the lines. There also comes an element of speculation with this. And that's because if you say, I am, I typically, traders aren't going to buy puts every day of the year. So why would you go out and buy a put now? Well, because I think the market's going to start getting a little dicey, or I think things are, we're heading into October, and October is a bad month, so let me go buy some puts. Well, that's speculating. You don't know, so even though you're thinking it's a hedge, there's an element of speculation to it. So that's why it's blurring the lines. It's always very difficult to say exactly what's going on. But in this case, notice what we've done. We have increased our break-even point. When we had the shares at 100, we would break even at 100. If we pay $5 for the put, we have to make that up. So it gets pushed forward to 105. Now that stock has to move $5 or 5% to do what? Just to break even.
Break even.
If we own the shares, we'd be up 5%. Right. We'd be up 5%.
You were trying to cover your downside. So
exactly. We're getting rid of this.
You got to pay for that. If you want to do that, then perhaps you got to give something up. And what are you going to give up? That's what Bill's showing you right here.
Correct. It's going to come from the upside. So we're saying, okay, I'm going to take a small reduction in gains. Notice it's not 100%. When we own the shares, we had 100% of the upside. I still have 100% of the upside, just the blue line is shifted lower by 5, in this example, by $5. So we can make money forever, just as if we had the stock, just minus $5. So why did we spend the $5? All right, so again, we're flattening this out. We're giving this up in exchange for what? Keeping 100% of the gains, minus 5, but reducing a big reduction in the losses. So that is a very classic hedge. We gave up some, not all, of the gains in exchange for a big reduction in the losses. So most of the time people would say, oh yeah, that's just an outright classic hedge. But as I mentioned before, there's still a degree of speculation to it. We all know that stocks typically earn about 8 to 10% per year. And if you look at your option premiums, a lot of times they're going to run 20% on an annualized basis. Well, you don't need to be a mathematician to figure out that earning 8% and spending 20% is not a good long-term deal.
No, that's not going to work.
So what you do, right, what you don't want to do is say every single month I'm going to go out and buy puts. Not going to work. Or I'm just going to buy a 1-year leaps option on puts every single year. Bad idea. So now the question becomes, if you are going to hedge, when do you hedge? And now that's why it's blurring the lines, because there's still going to be an element of speculation to it. All right. But overall, I think most traders would say that is a hedge. All right. Now, what happens? We hear this a lot, Stu. People say, well, you know what? I think things are going to start getting risky. I'm going to go out and buy 2 puts. I want to doubly hedge. I really want to make sure I'm going to guard that downside. Well, is that a hedge? Just because you have stock and just because you're buying a put, which is usually synonymous with an insurance policy, multiplying it by 2, is that still a hedge? Good question. So here we go back to our shares of stock, straight line. If we buy one put, what happens? What we just saw. We flatten out, we get our bend right there at 100, and we flatten. What happens if we buy a second put? What happens to our risk graph here, do you suppose, Stu?
No, that way. It's gonna go up.
We're gonna actually have negative deltas on this side, because instead of right now we have 0 deltas at expiration. That's what the flat line means. You're effectively have no shares of stock. Why? Because if you're down in this range, you would exercise the put and say goodbye to your shares. You have no deltas. But if you buy a second put, what happens? Now you've moved from the blue line to this. Interesting. So notice what we've done. We used to have losses of here. We've increased the potential losses, right? We used to be able to lose down to the blue. Now we can lose down to the red. So we've increased the potential losses. What happened? Why were we doing this? Even though people might not realize it, because now they can actually make money if it falls. Well, that's no longer a hedge. That is outright speculation. So that is speculation. However, keeping with our theme here, there's still a little bit of, it could be a hedge. Under what conditions?
Right. Remember what we were talking about how the deltas are always changing?
Yep.
Right. Like, is this where you're going, Bill? Right.
It's exactly where I'm going. Yep.
All right, go ahead. You take it.
Yeah. So the thing is, if somebody says, I want to buy a 60-day put because I really want to get hedged, and even if the market falls, I want to make money. That's not a hedge. But what if somebody says, I've got 100 shares of stock, but I want to buy 2 puts because I want to insure it for the day or the next couple of days?
And let's say they want to buy the at the monies.
They want to buy the at the monies. Now, again, whether that's a good idea is a whole separate discussion, but let's just say that's what they want to do. Well, now you could say it's just a delta neutral hedge because they're long 100 shares.
It's going to be a 50 delta put.
Yep, 2 delta or minus 50 times 2. So now they've got basically a perfect hedge, but only over a very small interval. So you have to say over a day, how far is the stock going to move? Probably not a lot. It's not but it would be almost a perfect hedge over a small range. So again, now you could say, well, no, it's not speculating, it's hedging. So again, we have to define, are we looking for small price movements over a couple of days maybe? Or are you looking to hold it for 60 or 90 days and actually thinking I'd like to make money if the markets come unraveled?
And it doesn't even have to be 60 or 90 days. I'm kind of thinking through this. It's pretty interesting, right? So
it could, right?
Suppose you have your two puts against your 100 shares, and they're delta neutral, and the stock goes down a little bit, or a lot, or half a lot, or whatever that means. And now you have Mr. Gamma coming into the fray, and now all of a sudden you're short 150 deltas from the put because they're now a 75 put delta instead of 50, right? And you still have your the same number of shares, but now you're short overall net delta.
Yep.
Have you now crossed the line from hedging into?
Exactly. It changed it. Gamma changed it for you, whether you wanted it to or not.
Yeah. Yeah.
Yep. Very good point. So again, we're trying to show you that even though the definitions are usually nice and clean cut, that we're going to give up some of the upside in exchange for reducing the downside, the lines usually get blurred all the time. It's really hard to say what is hedging and what is speculating if you really think about it. And so that's why we think a lot of traders struggle with this, because sometimes it's not real easy to see. We have to really dig deeper and say, what is it we're trying to do? So if I ask this question to a trader, and let's say that they say, oh yeah, well, I hopefully I'll make some money because I think it's really going to come unraveled here, and I'm going to buy 2 puts. Well, they've increased the downside. They're trying to hold it over a long period of time. They're hoping to make money from it. I would say that's speculating.
Mm-hmm.
But as you mentioned, if they say, oh, I just think it's going to be, maybe for this earnings report, I think it might fall from, it could fall a point or 2 or 3, but I've got a whole bunch of shares. Well, then, yeah, maybe they're just trying to keep it delta neutral. in which case I'd say it's probably more of a hedge. Okay, so there we go. So now let's take a different look here. Let's take stock plus a short put. Now we hear this a lot from traders because they'll say, well, if I sell an option, whether it's a call or a put, I collect cash, the almighty credit that everybody likes to get, and that credit reduces my risk. So therefore, if I sell a put, I'm hedging. And so it kind of gives them the green light to start selling all of these puts because they're doing it for protective reasons. I'm selling puts to get cash and I'm hedging. Well, are you really? Well, let's go and take a look at the risk graph. Here's our shares of stock. And now if you sell a put, what happens to that risk graph?
Oh, are there people actually out there somewhere that actually would look somebody in the eye and say, if you sell a put, you're hedging your long stock?
I hear it quite
Do
often.
those people really exist?
They do. It is not a figment of your imagination. I know. But this is why we like to teach it. There's a lot of people that will tell you this is a hedge. Now we're going to find out again, it's blurring the lines. So think about what happens. A long put has what? Negative 100 deltas, right? You have the right to sell those shares. So a short put is going to flip it. You're going to be long deltas. It's actually a bullish or neutral to bullish strategy. It's like a covered call. But if we combine it with a strategy where we're already long 100 deltas down here, we're now going to be long 200 deltas. So we should, just trying to show you how to visualize and think through this, we should increase the slope of this down here.
Right, you're longer. You're getting
right. We're longer on the downside, but on the upside, we know that short put by itself would be flat, and we'll still be long 100. So we're going to have 100 on the upside and 200 on the downside. So we should get something that looks like that. And if we put it in our broker's platform, look at that. Exactly what we got. Now here I did it with the 95 put, so we can see that's where the bend is. If we did it with 100, it would just be there. But take a look at our risk graph. What happened? We have increased the potential gains. Our break even is now 95. So could you say it's a hedge? It does reduce the downside, again, blurring the lines. But what's the bigger picture here? What have you done?
the bigger picture.
You've doubled the downside risk.
It's absurd. I mean, I can't believe that people actually do this.
Oh yeah. Yeah, they'll sit there and sell these puts and say that they're doing it because they can create this hedge. Does that create a downside reduction in there? Yes. Again, it's blurring the lines. You can't dispute that. But we also have to say, what else did it do?
So we actually see this quite often, not quite often, but we see this every now and then. And we even see it on the UOA tape where we see like people go ahead and buy these calls or they buy this call spread.
Yes, we do. Yep.
And underneath, they sell this put to finance the upside.
To finance it, yep.
And that, I mean, look, I'm not here to say yay or nay. I'm here to say, you are reducing that upside exposure in dollars, but you are also taking on a lot more risk.
And you have to say, what's the bigger weight? I mean, yes, you've got a few little crumbs right here, relatively speaking, not much of a hedge, but look at what you've done to the downside. So you have to say, is it really the best hedge? We have 100 deltas here. We have 200 deltas here. Again, it's blurring the lines. You could certainly make an argument, but I think the bigger issue here is what? That you're increasing the gains for increased risk, which means that it is definitely leaning more into speculating.
If you're absolutely willing to take the shares at that lower price, the additional
could be a different story. Yep.
Hey, look, go for it. But again, you just have to know that that's what you're doing. It's not like sell, put, get money, have hedge. It's just not that simple.
No, it's not. So option sellers generally are accepting risk, especially if it's a naked option. But in a case like this, if you are selling puts against long shares and you're only focused on the credit and that cash and going, well, gee, I can get $5. I can get a 5% downside hedge. Very true. But you got to dig deeper than that. What else happened?
What happens?
This is why your risk graphs are super important. Throw them up in your broker's platform and take a look.
What happens down 10% or 15%? You know, that's what you got to.
Now you're going to find out it's not so fun here. Yeah, if you drop a little bit, and again, that's where it could be where the speculation comes in. I think it might be a 3 to 5% drop. Okay, yeah, that cash is going to hedge you. But what if you're wrong? What if it drops way down here? Are you willing to take that risk in exchange for that small hedge? That's really what the question comes down to.
What if it turns into like a, you know, a United Healthcare, or what if it turns into a Peloton back in the day, or what if it turns into, oh, the market, you know, your timing was horrible in the market.
PHH went from what, $45 to less than $2 in what, a couple of days?
Yeah, it went to nothing, or, you know, the stock went from, you know, whatever. You had a 20 or 25% correction in the market, and your stock happened to go along for the ride. Look, these things happen,
Yes, they do.
right? You got to think about that, and you got to be able to say, hey, I'm willing to take that risk, and that's okay. If you ask yourself that question and you're truly honest, and yes, then I guess it's okay.
Yeah, and that's another good point. If somebody says, "Look, I'm absolutely willing to buy more shares. In fact, I've got cash on deck, willing to do it." So now you could, well, this is an assumed risk. They're willing to take it. So yeah, now the focus is more about this. So again, blurring lines, you have to really think, what exactly are you trying to do before you make those decisions? We hear that a lot where people say, I want to go out and sell options, and they just tell part of the story. I get this cash and I reduce the downside. Check, that is true, but you have more digging. What else changed? And that's a very good question to ask whenever you're thinking about strategies like this. Put it in your broker's platform. And like we've shown you on a couple of examples, try to visualize what's happening. Use the platform as a check, and then say, what else changed? Yes, it is true that you reduce this downside a little bit, but what else changed? And you go, look at this downside.
Yeah.
Much more risk down here.
Like these risk graphs that we do every week.
Every time.
They are your best friend, right?
They tell the story. They tell you've heard the expression, a picture's worth 1,000 words. This is why.
We get this all the time. You know, can you, you know, I want to buy this and sell this. Can you evaluate that? Well, yeah. This is the answer.
Yes, it is.
This gives you all the answers. If you can picture this risk graph in your mind before you actually, you know, put it into your platform, or put it into your platform and understand it, you know, this is your risk. This is your reward. This is what can happen down the road. You can push it forward in time. You can change implied volatilities on the broker's platform. They're so sophisticated these days.
That's right.
That you can actually, you know, create these outcomes in the future and see what the numbers actually look like.
That's right.
And a lot of these answers, most of these answers, all of these answers, all these questions,
all come from here.
They all come from here. Yeah.
Yep. So we hope that gives you some things to think about. One more little plug here from marketrebellion.com/get started. Topics just like this that hopefully you're seeing are super important to help you make better decisions. So marketrebellion.com/get started. Let's try another one, Stu. Stock plus a short call. Now this one has a special name.
Yeah, it's called income producing strategy.
we hear this all the time. It's a covered call. People talk about it as generating income. But again, blurring the lines. Let's take a look at this one.
I mean, you could, you know, look, I could make an argument for both sides of that.
Sure you can. Yeah, so here's our long shares of stock. When we sell the call, think about visually what's happening. I'm no longer going to have unlimited upside. If I sell the 100 call, I'm giving up all gains above 100. I'm giving somebody else the right to buy my shares at 100. So they're going to exercise no matter, you know, for any stock price above. So we should flatten, but I should also have what? I should still have unlimited downside. I should still have 100 deltas down there. So if we do that, there we go.
And, so look, you have just follow the money. I tell people that all the time. Follow the money. Take in $5, then you have there it is, right? You have $5 that you can absorb, kind of. Right. You have $5 in your pocket that can go to zero. You get to have that money, and that will reduce your downside. But that $5 runs out of $5, right? It goes to zero. And that's it. That's it. That's all your protection.
So that's why it's not the best hedge. It's a small hedge. Normally we said give up the upside or some of the upside in exchange for doing what? Making a big difference to the downside. Notice that we're actually doing kind of the opposite here. We're getting a small downside hedge, but what are we doing to the upside here? We're giving it up, giving basically all of it up. And then we're still maintaining all of the downside risk, just minus $5. So is this really the best hedge? Again, blurring the lines. That's the main reason for doing a covered call, is for the hedge, but you have to realize that you are always assuming the downside risk.
And that might be fine.
Might
Right?
be
If
fine.
you were going to own the stock anyway, no matter what, for whatever the reasons, maybe
Right.
it's whatever it is, um, and you were going to accept all that downside anyway, and you were willing
Some
to,
hedge is better than none.
if you were willing to give up some of that upside or a lot of that upside,
Right.
in return for getting paid some amount of money, well, then this is for you.
And also, I don't have slides for it, but kind of along that same note, we see a lot of people say, well, I don't want to give up this much. Let me sell the 120 call out here for 10 cents. Well, now your black line gets moved from there to there. How much of a downside hedge is that? Can we call that zero? Technically 10 cents, but basically might as well be nothing.
And you know what the
And
funny
yet,
part of that is?
and
People
yet
say,
all,
oh, when it went
all
to 120, I made all this money.
off the covered call. No, you didn't. You made it off the stock. Had you not sold that call, you still would have made those 20 points. The covered call had nothing to do with it. The only thing that the call did in that example was to knock this down by 10 cents. So again, we always have to think about blending. If you are going to do covered calls, make sure you're getting a sizable amount of cash, which is up to the trader, relative to the volatility and the value of the assets, but also that you can give yourself some type of gains. And that's when you'll make your better decisions. So a lot of times with the covered calls, it comes down to the assumption of risk. So the quality of a covered call hedge depends on why the shares were purchased. We talk about this a lot in Q&A. If the shares were already in the account, I've been holding Microsoft for 10 years. I don't care I don't care about the downside. I'm just going to keep holding it. All right, then you could make an argument that selling calls reduce the downside risk because you were already assuming that downside. But what if you go and buy the shares just to sell the calls? Now what you're doing is really a synthetic put. You have increased downside risk that was not there in your account, and you did it to do what? Increase the returns. So even though it's the same strategy, one could be hedging or at least leaning in that direction, and the other is outright speculation. So think about this. If you have cash, maybe let's call it $10,000 cash for 100 shares at $100, and you now buy the shares because you want to write calls, what happened to if this is the only position in your account? What happened? You went from flat, doesn't matter what the stock is doing, it's not going to have any effect on your value, and now you've gone to this. All right, so you've now introduced risk that was not there before so that you could do what? Write this call. So yes, you can see that you do have the potential to make more money from the blue line going to the red, but you've also increased the risk. So again, it depends on the assumption of risk. If you already had the shares or absolutely willing, this is where you have to be honest with yourself, I'm totally willing to buy the shares and hold them even if options didn't exist. All right, then I would lean more towards that a covered call is giving you a little bit of a hedge. But if you're buying the shares just because you want to sell these really premium rich calls, I would say that's more like selling naked puts. Okay, so yeah, you get this little sliver of a gain, but remember, you've really increased the downside. So there's lots of things we could go through, lots of risk graphs. We hope that encourages you to try some on your own, especially if you're thinking that you want to create a hedge. That's big, especially in today's markets. People say, I want to hedge this position. So we've hopefully given you some things to think about. Don't just think about the cash that's coming in. Think about the big picture. How did the risk change? And overall, what are you doing? Are you increasing the risk in exchange for increased profits? That's speculating. Are you giving up some of your gains in exchange for chopping off a bunch of potential losses? Then that's hedging. So Stu, come to the end. Chalk Talk. We've got 100 shares of ABC. You're fearful of the share price falling. If you buy 2 puts, are you hedging? What do you think? Uh-oh, I think you're muted.
All right, sorry about
There we
that.
go. So what do you
Are
think?
you hedging? Maybe.
Yeah. That's why we call it blurring the lines. That's what I came up with. It depends. So again, just for a recap, if you are buying it for a short period of time, I've got 100 deltas. I buy 2 puts. That's 100 minus 100 deltas. That's to kind of give me a delta neutral position, but only over a short time or a short stock price interval. Because as Stu said, those gammas are going to start accelerating that if it falls further, and then we're going to move into the realm of speculation. So talk about confusing. This stuff can definitely blur the lines.
Let me just end with a quick example here. I'm looking at, and I kind of hear this fairly often. In high vol stocks like Tesla, let's just take a look at Tesla these days. That's that at the money volatility, 30 days out, that's trading somewhere around 50, give or take a couple points. I mean, that's $300. That's a good chunk of money. That call is trading for about 18, 19 bucks.
Yeah.
And you might say, hey, that is like incredible. Let me go ahead and sell that call and try and make that money. Well, it's priced that way because that's how the stock behaves.
That's right.
Range of motion up and down is a lot. I mean, you think the $19 is a lot. Well, it's a lot because its range of motion of the stock is a lot. So, go ahead and buy that stock. You're introducing a lot of risk to the downside.
A lot of risk.
Right.
And people just do what? They focus on the $18 cash.
Yeah.
And they go, oh, well, the Tesla's not going to fall. Let me go grab the $18. Think twice about that one.
Which is a lot. I mean, it's $1,922,000. It's a lot of money. You go sell 5 of them, all of a sudden it's 10 grand. It's a lot of money, but there's a lot of risk associated with it as well, and you have to understand it, which could kind of lead into, well, let me buy the stock replacement call. Let me do the vertical. Let me buy the 85 or 90 delta call instead of the stock, and I can reduce my cost that way.
Yep.
Look, you're still buying all that intrinsic value. There's still a ton of downside risk.
That's
you
right.
reduce it. There's still a ton of downside risk. And how do you figure out what it is? Put it on your risk graphs, everyone.
There you go.
It'll give you the number to the penny.
So the brokers' platforms will give you the pictures, and hopefully now you've got a little more knowledge to do the analysis to figure out, are you really hedging or are you speculating? And it's a difficult question because the lines are always blurred. So we hope that gives you some good things to think about. We appreciate you joining us, and we will see you next Thursday for Coach's Corner. We'll see you then.